Hello, everyone, and welcome to this lecture on forms of business organizations in the UK, and we'll particularly focus on partnerships. In this session, we'll explore how partnerships fit within the wider context of UK business structures, their legal foundations, key principles, and the ways in which liability and management operate. By the end, you should have a clear understanding of the various different kinds of business organizations, their advantages and disadvantages, and how they compare with each other. In particular, you'll have a very clear understanding of how partnerships work, their advantages and disadvantages, and how they compare with other business forms such as companies and limited liability partnerships. In England and Wales, the main types of business structures include the sole proprietor, the partnership, and the company, which may take the form of a private limited company, an LTD, or a public limited company, a PLC. In addition, there is a relatively modern hybrid structure known as the limited liability partnership. Each of these structures offers different degrees of complexity, legal personality, and liability protection. A sole proprietor, also known as sole trader, is the simplest form. It involves an individual carrying on a business on their own account. There's no separate legal personality, meaning that the individual is personally liable for all debts. There are minimal formalities to set it up, which makes it attractive for small enterprises or freelancers. The partnership is one of the oldest business forms, and it's deeply rooted in our common law. It operates under both the Partnership Act 1890 and for limited liability partnerships, the Limited Liability Partnership Act 2000. At its core, a partnership arises from an agreement between two or more people to carry on a business together with a view to profit. Section 1, subsection 1 of the Partnership Act 1890 defines partnership as the relation which subsists between partners or persons carrying on a business in common with a view of profit. The key elements here are, firstly, a business, a relationship between two or more people, and the intention to make profits. Importantly, the Act also clarifies that business includes every trade, occupation, or profession. The case of Khan and Mia illustrates this definition well. It shows that a partnership may exist even before trading formally begins, so long as the parties are acting together with a view to a profit. In this case, several persons intended to run and operate a restaurant together. The question was when exactly the partnership came into existence, because there were people wanting to sue on contracts that were concluded, and the question was whether they could hold the partnership liable, or were they restricted to the individuals negotiating the contracts. The Court of Appeal held that a partnership came into existence only after the restaurant actually opened to serve food, and not yet during the preparatory stages. However, this was overruled in the House of Lords, where it was held that since before the restaurant or any venture could actually start and open for business, a number of preliminary activities such as leasing premises, opening bank accounts, buying equipment, etc. were necessary. Thus, the court held a partnership had been established not at the moment of commencement of trading, but when the activity in question were actually embarked upon. So, it could be that the circumstances tell us that a partnership came into existence. A partnership, therefore, is formed by agreement, and an agreement, as you know, that is what a contract is. A contract is an agreement, and you also know that contracts don't need to be in writing to be valid. Therefore, a partnership can be formed either orally or in writing as long as there is an agreement. If in writing, the written agreement is often called a partnership deed. This document will typically outline matters such as the firm's name, its duration, capital contributions, and how profits are to be shared. Unlike companies, partnerships do not have a recognized separate legal personality, and therefore partnerships do not benefit from perpetual succession. Perpetual succession means basically you just go on and on. Your life goes on in an unlimited sense. So partnerships can exist for a fixed term, or they can operate as what we call a partnership at will, which means that any partner can end the partnership by giving notice. Two key principles govern partnership relationships: contractual freedom and the utmost good faith, or the Latin for that is uberi mai fides. Unless otherwise agreed, the default rules under sections 24 and 25 of the Partnership Act apply. These give partners equal rights in the management of the partnership, in decision-making, and in profit sharing. Partners also owe duties of the utmost good faith to one another, meaning that they must act honestly, fairly, and disclose relevant information. These duties come from both the principles of equity as well as statute law, such as the Partnership Act itself. A partnership is referred to as a firm. I know that very often we call companies firms as well, but that's not technically correct. A firm refers to a partnership. And a partnership is not a separate legal entity like a company. In Baird's case, formally it's referred to as Baird versus Lease, which was a case decided in 1924. In this case, the court confirmed that the partnership has no separate legal personality distinct from its partners. This means that the partner or the firm itself cannot own property or incur obligations independently. Instead, the partners personally own the firm's assets and are personally liable for its debts. This case underscored the principle of unlimited personal liability in general partnerships. Each partner is also an agent of the firm. If you look at this triangle, it shows the classic relationship. The principal being the firm, and all of the partners being seen as agents of the principal. They can then conclude contracts with third parties, which will form a binding contract with the firm, which in turn is made up of all of the partners. So each partner is also an agent of the firm, meaning their actions bind all of the other partners when these actions are done in the ordinary course of business of the partnership. Liability is one of the most crucial features distinguishing partnerships from companies. Where you have unlimited liability, it means that you are potentially liable for all of the debt of the organization. And this is what we have in partnerships. Whereas when we have limited liability, your liability is limited only up to a certain sum and no more. So you won't be held liable for the organization's debt beyond that. And this is what we usually have with companies, where the shareholders in the company do not have unlimited liability for the debt of the company. Their liability is limited only up to the sum of what they owe for the share that they've bought. So to repeat, liability is one of the most crucial features distinguishing partnerships from companies. Partners are jointly liable for the firm's contractual liability or contractual debts, and they are jointly and severally liable for torts committed by any partner in the course of business. This means that a claimant can sue any one partner for the entire loss, leaving that partner to recover contribution from others. Let me briefly refresh your memory on what these forms of liability mean. If parties have joint liability, then they are each liable up to the full amount of the relevant obligation. So if a married couple, for instance, takes out a loan from a bank, the loan agreement will normally provide that they are to be jointly liable for the full amount. If one party dies, disappears, or is declared bankrupt, the other individual remains fully liable. Accordingly, the bank may sue all living co-promisors for the full amount. However, in suing, the creditor has only one cause of action, That is, the creditor can sue for each debt only once. If, for example, there are 3 partners and the creditor sues all of them for the outstanding loan amount and one of them pays the liability, the creditor cannot recover further amounts from the other partners who didn't contribute to the liability. The converse of this is several or proportional liability. Several or proportionate liability is where the parties are liable for only their respective obligations. A common example of several liability is in syndicated loan agreements, which will normally provide that each bank is severally liable for its own part of the loan. If one bank fails to advance its agreed part of the loan to the borrower, then the borrower can sue only that bank, and the other banks in the syndicate would have no liability. Finally, joint and several liability. Under joint and several liability, a claimant may pursue an obligation against any one party as if they were jointly liable, and it becomes the responsibility of the defendants to sort out their respective proportions of liability and payment amongst themselves. This means that if the claimant pursues one defendant and receives payment, that defendant must then pursue the other people who are indebted for a contribution to their share of the liability. Joint and several liability is most relevant in tort claims, whereby a plaintiff may recover all of the damages from any of the defendants regardless of their individual share of the liability. The rule is often applied in negligence cases, although it is sometimes invoked in other areas of law as well. Coming back to partnerships themselves. Under Section 6 of the Partnership Act, each partner is an agent of the firm. As long as the act is done by the partner within the ordinary course of the firm's business, the firm and all the partners are bound. I've given you the Section 5, so you can pause and read the section on your own if you like. But let's look at a case that illustrates this point. The case of J.J. Coughlin Limited and Ruparelia. I hope I pronounced that name correctly. J.J. Coughlin Limited invested $1 million through Mr. Ruparelia, a solicitor, in a firm. Mr. Ruparelia promised them a 6,000% return on their investment. But he used the money for fraudulent purposes and never intended to pay it back. J.J. Coughlin Limited then wanted to sue Mr. Ruparelia's partner. The court held that what Mr. Ruparelia did was not usual for the kind or class of business that the partnership were doing. Think of it. How many solicitors firms do you know that offer investments that promise a 6,000% return on investment? That is not the usual kind of thing that forms the business of solicitors firms. The court therefore held that this partner's actions were not in the usual course of the firm's business. So the court said that a partner's actions that were carried out in the ordinary course of the firm's business would bind the partnership and all partners. Even if the particular partner exceeded their internal authority, the firm remained liable to third parties who reasonably believed that the partner had such authority. Now, in this case, the question was that a reasonable belief to hold? So the decision in this case reinforced the principle that each partner acts as an agent of the firm, and it ensures that third parties are protected when they are dealing with a partner of a partnership in good faith. All right, let's talk about a firm's liability in tort next. That's basically when something goes wrong and the firm causes harm to someone else. Under Section 12 of the Partnership Act 1890, liability here is joint and several. Once again, I give you some extracts, so pause and read the extracts from the Act if you like. So what that means, Section 12 liability, in practice is that if one partner commits a wrongful act while running the business, the person who's been harmed can choose to sue one partner, a few of them, or even all of them for the full amount of the loss suffered. It's then up to the partners themselves to work out who ultimately pays what. Section 10 is the really important section. It says that if a partner does something wrong in the ordinary course of the firm's business or with the authority of the other partners, then the whole firm is liable, just as if every partner had done it themselves. So even if only one partner is directly involved, everyone shares responsibility when the act is connected to the partnership's normal business activities. And finally, Section 17 deals with how long that liability lasts. New partners aren't on the hook for things that happened before they joined, but partners who leave can still be liable for things that happened while they were part of the firm, unless there's what's called a novation, which basically transfers that liability to someone else. So the key takeaway here is that in a partnership, liability doesn't just belong to one person, it's shared, and it can follow you even after you've left unless it's formally resolved. The limited partnership, sometimes called a sleeping partnership, introduces the concept of limited liability for certain partners. Please don't confuse the limited partnership with the limited liability partnership, which we'll look at next. So under the limited partnership model, at least one partner must have unlimited liability, but others, known as limited or sleeping partners, are only liable up to the amount that they have invested. In exchange, however, these limited partners cannot take part in the management of the firm. Next, the limited liability partnership. Once again, don't confuse this with the limited partnership or the sleeping partnership, which we've just looked at. The limited liability partnership, or LLP, combines features of both companies and partnerships. Established under the Limited Liability Partnership Act 2000, it provides the organizational flexibility of a partnership with the limited liability of a company. This therefore accommodates professions such as the medical or legal profession, where practitioners are by law not allowed to form companies. The LLP has a separate legal personality. Let's go back. Meaning it can own property, sue, and be sued in its own name. Members of an LLP are not employees but agents of the LLP. They share profits, participate in the management according to the LLP agreement, but importantly, the LLP has perpetual succession. Changes in membership do not dissolve the organization, unlike a traditional partnership. Members of an LLP enjoy limited liability. This means that their exposure is generally limited to the capital that they have contributed unless they engage in wrongful or fraudulent trading. However, the LLP as such, of course, can be held liable in full for a debt incurred on its behalf by a partner. If the LLP becomes insolvent, normal insolvency and winding up rules apply, including provisions under sections 213 and 214 of the Insolvency Act, which address fraudulent and wrongful trading, respectively. For a discussion of fraudulent and wrongful trading, see a separate lecture that I will upload on these topics specifically when we deal with insolvency and liquidation. Back to the LLP. An LLP can be terminated by agreement amongst the members or through insolvency proceedings. This structure, the LLP, therefore, offers both flexibility and protection for modern professional and trading firms. To conclude, partnerships remain a foundational element of business law in the UK. The general partnership relies heavily on trust, good faith, and personal liability, whereas newer forms such as the limited liability partnership offer greater protection and adaptability for today's business. Thank you for watching, and I'll see you in the next one.